The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Okay, it is Friday the 6th of June. Jeremy, welcome back.
Hi, Gareth. Yeah, good to be here.
Been yet another fascinating week. A lot going on across the pond that I'm sure we'll come on to in a minute or so. But in the big world of macroeconomics, what's been catching your eye?
Well, I was going to say until the big Trump-Musk bust-up broke overnight, that this week had been rather quiet in the context of recent weeks, and sort of started in a slightly directionless fashion with absence of sort of new trade deal news and sort of inconclusive peace talks. And I think markets had become relatively becalmed. Dollar continued to weaken, partly in a response to some weaker US ISM survey data. That dollar weakness certainly ignited a recovery in precious metals, in gold, particularly in silver and platinum, along with some strong moves in some of the junior gold mining stocks in the States. But yeah, some of the US jobs and survey data were sort of consistent, certainly with a slowing economy in the US, and gave bond investors, I think, confirmation that perhaps after all, a recession might be the sort of least worst outcome for the bond market and for the Treasury for that matter. And we have seen, I think, around this sort of confirmation of at least a slowdown in the US economy over the week. We've seen bond yields falling, and I think that's helped, along with a slightly firmer equity market. So don't necessarily think this signals a return to normality. And then, of course, from yesterday afternoon, I think our time, Musk's exit from the White House, well, it's just blown out, hasn't it? The best friends forever are no more. And, their relationship seems to have lasted for less than a year. There's going to be lots of juicy political fallout from all this that the media are going to be all over. But my take on this is that this is a fallout over fiscal policy, over the big, beautiful bill. We know that Musk a few days ago called this bill a pork-filled budget-busting abomination, and things have gone from bad to worse.
Yeah, Musk's behaviour post his departure has been quite interesting, the way he's turned on Trump pretty aggressively and pretty quickly. And it's interesting with Musk, he talks a lot about his views on spending. He doesn't talk much about his views on taxation, but he's clearly a big fan of smaller government and smaller federal spending in particular. It doesn't seem that Doge has really worked. I mean, there have been lots of quick headlines that they made and then very little follow-up. And the trackers that have been out there trying to follow how much money they've actually saved have come up with some, I think, disappointingly small numbers compared to what they'd been claiming at the beginning. So what does that mean in terms of where Trump is, where Scott Bessent is, and the way the world rolls on?
Well, I think you're absolutely right. Doge has failed. We don't know if Musk was set up to fail by Trump, or whether both of them were beaten by the deep state. I mean, everyone's going to have their own view on that. But Musk, his political conversion less than a year ago was based on reducing the size of the state. And that project that he came in to do hasn't worked. And the consequences for financial markets is that nothing is going to stop this train of US rising debt and fiscal irresponsibility around the BBB and beyond. And to your point about, if Scott Bessent is the world's biggest bond salesman, then in the same context, Musk is the world's biggest gold salesman, because Treasury policymakers' only option left now is to double down on Bidenomics, to juice growth in the economy to outrun the debt. And that is essentially why we've had this global term premia problem. We've had these very problematic government bond auctions in Japan and in the US. And as Paul Tudor Jones has put it, all roads lead to inflation. And as we said before, in order for the world to buy Scott Bessent's bonds, US debt needs to be made more attractive. And in order for it to get funded, that means the rates on offer have to go up, the return on that investment have to go up, and the real dollar value of those bonds has to come down. This is a structural situation. There'll be policy interventions on the way to smooth this all out. And there is obviously in the real world a slowing US and probably global economy that will change things from time to time. But I think that is the structural direction, and the fiscal situation is being kicked down the road again. The can is being kicked down the road.
You could argue that it's even worse than that because, yeah, you're right. Clearly, they're going to keep spending. They're going to keep trying to cut taxes or limit the tax take to keep Trump's MAGA backers happy. But the issue at the moment is you've now got Musk sitting just outside the sidelines, screaming and shouting about how unsustainable it is. So he's actually making Bessent's job even harder.
Yeah, exactly. Hence, he's the gold salesman.
Yeah.
And I think it's going to be interesting to see whether Musk goes back to his business, doubles down on his plan to escape to Mars, whatever else, or whether he remains in the political domain. I can't remember which US president it was, but he said of J. Edgar Hoover, I'd rather have him on the inside of the tent pissing out than on the outside of the tent pissing in. That's the reality. I mean, you probably want him on the inside of the tent.
Yes. And it doesn't sound like he's likely to go back in either, but
indeed.
But let's see. Okay. So the US has had a very public and bitter falling out of a couple of their main players. Meanwhile, what's been going on in the UK? What have you seen closer to home?
Well, we've had the OECD downgrade estimates for UK's growth for this year and for next year. And I think the key takeaway is that for next year, the outlook for growth is quite significantly different to what is currently being forecast by the Office of Budget Responsibility. And this is all going on while Rachel Reeves is trying to tread the tightrope of fiscal responsibility in terms of her spending review. So I think this pressure is building up here, and I think this is likely to break out into the open in the coming weeks on which departments' budgets are being taken away. We've obviously got hanging over all this the spectre of increased defence spending, and the likelihood is we're going to get more tax increases, we're going to get spending cuts, and we're probably going to get looser financial conditions. And how it all plays out, I don't know, above my pay grade, but I think this is going to become the big economic story in the UK in the coming weeks and months.
Yeah, it doesn't feel like there's a buoyant global backdrop against which we can set our own stall out really at the moment.
No. And meanwhile, in capital markets, we've had quite a lot of talk around the Mansion House Accord in the context of the government's pensions investment review that was published last week. And obviously a lot of hope and expectation around an improved environment for our capital markets, for the issue of equity, for the overall health of the London stock market. And that received quite a big body blow this week, I would say, in the form of Wise announcing that it wants to move its principal listing from the UK to the US, and news of a slightly off-the-wall IPO called Cobalt Holdings that announced it was cancelling the plans to IPO.
Yes, the Mansion House Accord and the pensions investment review. Do you think there's anything in those that would lead UK investors to feel a bit more optimistic about things and that government help is coming?
Well, there's this whole issue about whether pension funds should be mandated to invest in UK assets, which I think one has to be careful what you wish for in these sort of situations, because if we go down that route, there's all manner of things that governments and regulators might wish for our collective savings and investment pools to invest in that might not be in our best interest. I think policy around just making the UK market an easier market to transact in, doing the simple things of reducing the frictions to transact on the market rather than using means of mandation of some form. But as I say, I think one has to be careful what you wish for. But there is definitely a lobby out there for UK pensions to increase their direct exposure to UK equities.
Yes, you're right. I mean, the morality of directing people to invest in certain places rather than others is always dangerous, but it would be safer to make the UK market attractive in its own right. And What I feel is it feels like people are trying to be more positive. I think there is an underlying attempt or hope that the market can recover and that funds flows can start to reverse. But as you say, Wise moving to the States, a pulled IPO. There's another small cap, micro cap company has announced plans to delist this week. So there is a steady drip of negative news mitigating against what I do feel is an underlying sort of attempt by market participants to reflate things.
Yeah, those things can happen, and capital flows globally can decide that the UK is a relatively more attractive place tomorrow than it was yesterday. And I think we are living in that type of world. So we're basically bouncing around on a global sea of capital, and that capital is shifting materially at the moment. And events overnight of what's going on in the States, Tesla, I think, was down 16% at one point yesterday, and a weakening dollar. All these things can lead to a calculus among global investors. Actually, we'll just park a little bit more capital in the UK, and that can make all the difference. In that context, the setup around the UK Pensions Investment Review or the Mansion House Accord are probably irrelevant.
You're right. If some of that US mega capital flows in our direction, it'll make up for a large number of smaller sins locally. So yeah, see how that all plays out.
So what about you? What have you been looking at in the UK this week?
So in the UK, sort of small micro cap, been an interesting week, actually. There's been a lot of news kicked off by IG Design Group, which is a manufacturer and distributor of greetings products and gift wrapping and that sort of thing. They announced the disposal of their troubled US business. They sold it for $1, but a share of proceeds if that asset is resold by its buyers. So there's an opportunity for a sort of an ongoing participation in the business. But the market responded very well to them removing what had been quite a difficult and challenging market for them. And obviously with Trump's tariffs and all those things still kicking around, it was going to be a difficult way forward. So I think the market was relieved to see that deal done. And then we've had a lot of other news, actually. We had Tiny Build Games developer gave a positive AGM update, which was good to see. We had annual results from Turn, the investor in IoT and various other sort of technology assets. SDI Group, which is a scientific instruments business, showed that their move along that M&A trail hasn't stopped. They made a small acquisition announced this morning. But probably one of the more broadly relevant pieces of news was from Van El, which is involved in groundworks and early stage engineering around house building. And they said that there'd been continued regulator-driven delays. The building safety regulator hasn't been able to keep up with the anticipated expansion in projects. So they were a bit downbeat on the back of that. And in parallel, we had a warning from another business, MJ Gleeson. So I think that adds to the growing voices saying that there is a recovery in UK house building. It is improving, but as we've seen for a number of people, that improvement or that recovery is taking longer than expected. It's a bit more problematic.
Yeah.
It's lower margin. Gleeson were talking about the fact they were able to pass through some of the cost increases that they're facing. So there is improvement across the house building sector, but it's not as rapid or as clean as people had been expecting. So it hasn't quite played out the way people had hoped.
Yeah, I think on a number of fronts, that is the case.
Yes.
We should probably have a conversation with Alistair and get a catch up on what's going on there.
We should get him back. No, absolutely right. So we'll try and do that over the next few weeks. And yeah, thinking about the future, what have we got in the immediate near term next week? What's on the macro radar?
There's a fair bit of data next week. Well, certainly later today, we're going to have the US non-farm payrolls. Next week, we've got some US inflation data, which I think will probably still show that inflation in the US is stubbornly running above target despite the slowing economy. And we've got the University of Michigan Consumer Sentiment Survey. I think all of these run the risk of showing that while the US economy continues to slow, the inflationary pressures in the economy remain elevated. That's the risk. I think in terms of the headlines, there's only one story going on, and it's going to be the continuing bust up between Trump and Musk to be continued. And I suspect for Trump, doing a deal with Elon might become a bigger priority than his higher profile deals with Putin or Xi. So
yeah, it will be interesting to see where Trump allocates his time over the coming 7 days. Absolutely right. So yeah, brilliant. Great. Jeremy, thanks very much once again, as always.
Okay.
And we'll talk this time next week.
Look forward to it.
Talk to you then.
Brought to you by Progressive Equity.